cars. So it will propel the car sales and the profits of Maruti. Okay, and the P ratio will look very high. Look at the the chart of this Maruti and just see the P ratio now. So let's look at the P ratio. See how the P ratio has climbed. Okay, fine. So this was the P ratio, which was 60, then it came down because there was a growth, kind of a scare, okay, because the HUL was not growing, it was just supposed to grow at only 1 point. So the overvaluation, weighed very heavily on HUL because the HUL has been growing at a very fast pace. But lately find that there is a saturation point. We understand why it has happened, why, that's a different story. We have to analyze that. But if you look at, the P ratio has suddenly jumped almost to 31 from a level of say 26. Okay, so the P ratio has gone up in the last few days because the company is going to do well. Okay, now coming back to HUL. Okay, sorry, Ultratech. So the P ratio, the PEG ratio. Okay, so basically the P ratio by itself is not a very good indicator. We should calculate the PEG ratio or the PEGI ratio. Okay, and how do we calculate the growth? So I'm just sharing you a site here to look at the growth. So go to trading view. So this is a site, okay, which you can open and go to so this is chargeable site, but it gives most of the information free. Okay, go to the markets. Okay, go to markets, go to countries, go to India. Okay, okay, then go to in India, go to Ultratech. Ultratech. Okay, so you may get a faster way of going it. I'm just moving it a bit slow. Go to the forecast. Here we have to see the forecast. Now if you look at the forecast, so this is a very important part of this thing, and you should be using quite often for making your this thing. So the price is 13,587 at the moment. Price target is he has said 13,600 or 587, whereas currently Ultratech is trading at 12,640. So there are a lot of analysts which are tracking. There are 43 analysts which are tracking Ultratech, and out of that 29 say strong buy, despite Ultratech being costlier because it's trading above the industry PE, but still the recommendation is to buy it. Okay, but we'll come to that later, and come to the EPS here and look at the annual here. Go to the annual tab. So it will go quarterly by default. Go to annual. So go to the annual. You will find the reported EPS and the estimate and the surprise. Now there are three rows here. One is the reported. How much they reported? How much it was estimated by the analyst? And was there a surprise, a positive surprise or a negative surprise? The estimate was higher, but actual reported was less. There's a negative surprise. Okay, fine. So out of the last 6 years which are given here, twice it has surprised the analyst and towards the positive side, but whereas twice it has given a negative surprise, a very good number, but 2 times it was almost close in line with the street. Okay, so whenever it is almost similar to the reported and this thing, we say it's line with the street. So when it beats the street, that means the EPS has been given higher than what the street was expecting. Street means all the analysts. Okay, so twice it has given a negative this thing in the year, but let's see. So it is currently reported is 208 in 2024, whereas it was estimated to give 221. So there is a 6% negative in terms of what the analyst was expecting. Now here what the analysts are expecting, they are about 50 analysts. Okay, so it is a mean of all what the expectation was, all the 50 analysts, whatever they said, uska mean जो है, that is coming out here. Okay. If you look at the top, so mean this thing EPS growth of all the people. Okay. So look at this number. So there is a maximum. Now here there is maximum, average, current, and minimum. So because it is based on the various analyst view, so a lot of people are saying it will go up to such an extent. Some people are saying it will go there. So the mean return actually is basically the maximum it can touch is 15,000. The average it will turn 13,000. So we'll look at the average. Average generally is more acceptable number rather than the maximum or the minimum. So it captures everybody and then it averages out. So averages normally are more realistic number than the maximum and the minimum. Similarly, the earning per share, it is every analyst, they are tracking the future growth of all the companies. So Ultratech, so they said it will report 221, but it reported 208. So next year it is 314, 401 and 468. Okay. So that means it is going to grow from 221 to about 468. So almost like 100% growth in the next 3 years, and more than 100%. So on an average it will be around close to about 35%, isn't it? So I show you how to calculate the average. It's simple average, which I show you on a template. So it is going to grow at almost like 35% growth rate. Currently it is trading at a P multiple of what? 45. Okay. If we divide it by 35, so it will be still, the PEG ratio will be more than 1. If we add the dividend yield, it will fall down a bit, but it will be still greater than 1. Okay. So it will be still costlier, but with whatever may be, then the analysts will say that, if you not buy now, you will miss the bus, because the investors will not let you, because every month, if you look at the mutual fund data, there are about 27,000 crores which have been invested every month by the mutual fund, Indian public. So they are buying it. Despite the FIIs or FPIs selling in the market, they are buying. So they always believe the Indian, retail and the institutional believe that India is going to grow and do very well. And yesterday the India GDP numbers were announced. Are you aware of that? India announced its first quarter GDP. What is the number? Just check. 7.8%, which is the highest. It was never expected. So we are expecting, the RBI was expecting 6.5, but India, had given a number which is 7.8. Okay. Of course, then they are always saying, the analysts will always give you this thing that we have a tariff coming, so it will, spoil the party of the future growth. But then we have the GST also coming, GST rationalization, and so many other things will come. The reduction in income tax, rates last year, which is going to also give a lot of money in the hands of people, and they are going to spend. Okay. So that is going to counter the 50% tariff, because 50% tariff is not going to impact so much India. It is affected sentimentally, okay, but it is not going to affect so much to the India's GDP. It is going to affect, jewelry. It is going to expect the cotton exporters, the rice exporters, which are not even listed in the stock exchange, except the jewelry. Okay, it's a negative news because of the sentiment, rather than going to impact so much India in terms of the GDP. It is going to affect, say, by 0.3%, 0.4%. So if we are supposed to grow at, say, 6.5, we may grow at 6.2 for at least, and it may not like this forever. Maybe that, some better sense will prevail and they will reduce the 50% tariff. Okay, fine. Okay. So I was just checking, after the 50% tariff, what are the exports which are going to be impacted? So like rice. So now if rice are going to be taxed by another 50%, so Pakistan is our competitor. So if you look at the Pakistan basmati rice and the Indian basmati rice, but Pakistan basmati rice become cheaper after the import duty, higher import, because they are going to be charged 19%, we are going to be charged 50%. So there will be a $0.2 dollar impact versus India versus American basmati. India will be costlier compared to the Pakistani, because they are going to pay 19% on basmati rice exported from Pakistan. From here it will be 50%. So clearly people will say Pakistan, but quality wise India rice is much better, because the longer grain, longer this thing, and whereas the by taste wise both are same, if I was checking. Okay, fine. So it is going to impact the rice exports, or maybe cotton exports, or maybe garment exports, or maybe gems and jewelry. So these are about $40 to $50 billion per annum kind of a game, out of almost like 100 $80-90 billion of exports happening every year to America, 40 crores are exempt anyway from the 50% tariff. That is the pharma sector. Okay, the iPhones which are manufactured in India, they are being exported to America, in the Apple factory in India. So they are exempt from that 50% tariff. So a lot of things gone, and only 50%, almost 40 to 50 billion dollars of exports are going to be hit, and most of them coming in a non-listed sector. So that is not going to impact the stock exchange. Okay, but the sentiment has become a little bit negative. So now, because since we are talking with China, Russia, more this thing, so people are a bit skeptical that whether it will be good to align with the countries who were against us few months back. Okay, but anyway, so the coming back to what's the time now? Yeah, okay, so the time is there. So let's go to this. Okay. Now, P ratio we have done to a great extent. You can just watch the video. I am not playing it. Okay, so please watch the video. Okay. Then, of course, there are certain other ratios which are very, very important. I am going to touch them a little bit. Okay. Now, the P ratio is based on what? The market price per share divided by earning per share. Earning per share is the net profit. Okay. Now, if you bring another matrix like P ratio, which is far superior and better, okay, in many respects, then that matrix will become better than the P ratio. So there are limitations of the P ratio. Though of course the P ratio is widely used, still, most of the people, all the analysis done on the P ratio. Okay, fine. But there are certain ratios which are competing with the P ratios. One ratio is called enterprise value divided by EBIT or EBITDA. Okay, so we have the enterprise value. I'm just writing it here. EV upon EBIT or EBITDA. So on the numerator we have EV, on the denominator we have EBIT. So the EBIT is replaced by the net profit, and enterprise value is replacing the market cap. So enterprise value is nothing but the market cap plus the debt. Okay. Now, when a company does business, it requires capital. So capital can be either borrowed capital, or it can be the own capital, that is equity capital. If you take entire capital, okay, the market value of entire capital, because that has been invested in the company. Okay. So enterprise value is nothing but the market cap plus the debt. More preferably the market value of the debt, but if the market value of the debt is not available, take the debt which is given in the balance sheet and add them up. Okay, fine. Huh? Which one?
Just like trading view. So trade on trading view, how will we go to forecast?
हाँ अभी करेंगे फोकस के लिए बता दो गो टू अभी बताया तो था मैंने नहीं खोला अभी कर दो आई एम जस्ट गोइंग टू जस्ट wait for a while, I'll just take you. So just complete this story. Just forget about the forecast. I'm going to take you to again. Okay. So enterprise value upon EBIT. So enterprise value is what? Forget about the forecast. Just take it out and just see what I'm doing now. Okay. Enterprise value is basically, what's the formula? Market cap plus debt minus cash. So if you complete the story and write the formula correctly, it should be minus cash. The simple version of the enterprise value. But if you go to more complicated version, then we minus the minority interest also, but we will do that later. Okay. So we have the market cap plus the debt minus the cash. Now excess cash means whatever cash which is lying with the company. Company is not using that cash except for some part of the cash. If suppose I have got 5 lakhs in my purse, I can't come, but suppose I am having 5 lakhs, I don't need 5 lakhs, isn't it? I need what? 5,000 in my cash or 10,000 for my day-to-day requirement, but I am giving 5 lakhs. So almost like 4,90,000 is excess cash, which I am not using for any business purpose. But since I have generated a lot of cash, I am just to find out ways to deploy it somewhere, but at the moment it is sitting idle and I put it in some kind of an investment. So I should exclude that because that is non-operating cash. It is not yielding to any income for the company at the moment. Okay. So the enterprise value represents the market value of all the assets and liabilities, all the operational assets and liabilities. Is that okay? So by looking from a different angle, it is market cap plus debt minus cash. But if you just say it, it is a market value of all the operating assets of the company, which has been financed either through equity or from debt. जो आपका equity और debt है उसी से तो आपने वो assets खरीदे हैं और उसकी market value आज इतनी हो गई है, which is representing the market cap because the reserves you have generated and you have bought more assets. Assets have overgrown. Okay, so it's a market value of all the assets and liabilities, isn't it? Okay, so enterprise value is what? Market value of all the assets and liabilities. So now, what is the just focus here, okay? What is the enterprise value? Is it coming here somewhere? Are you able to find the enterprise value here? Enterprise value is coming right at the bottom. How much it is? 3,94,000. And how much is the market cap? So by definition, the enterprise value should be slightly more than the the market cap because it includes debt. For the companies which are borrowing heavily, the enterprise value will go up. Okay. Now it is 3,94,000. How it is calculated? Go to the balance sheet. Okay. First go to the Ultratech here. 3,72,000. Just Srishti add 3,72,470. All others also do that. 370 itna. Then go to the balance sheet. Okay. Add the borrowing which is 24,102. The borrowing has to be added. The market value of the borrowing, but that is not given, so we are just simply adding this. Okay. Then we go to the the other assets. Take out the cash. Cash equivalent 1673. Cash equivalents because company will not hold all the cash. It will be holding some investments. Okay. So they are non-operating because their company has parked the money somewhere temporarily, which is earning about 5, 7, 10, 12, 15% kind of a return, which is not coming from operations. It is coming from non-operational activities. Okay. So if you just again arrive, so how much enterprise value you get now, Srishti?
3,94,903.
So you are getting the same here. Fine. So this is how do we calculate. Okay. And when you are making your project, you give the total calculations on your Excel sheet. Okay. Don't make a shortcut by recalling this number from the screener itself. You just calculate yourself so that you come to know how it has been calculated. Is that okay? Now we come to EBIT. EBIT is go to profit loss account. Okay, last time Srishti has corrected me, I was adding interest and depreciation both. It was only the interest that needs to be added to the profit before tax to arrive at the EBIT, isn't it? So go to profit before tax, which is how much? 7528. Okay, add interest. So 7528 plus 1651. Okay, add the numbers. Now whatever number you get, you take the enterprise value and divide by this. You will get almost the same number. Okay, fine. So just do that, and how much you are getting? How much you are getting? EV upon EBITDA. So EV EBITDA you will get. So it has been shown here. Screener. Screener का number ये है. What is the number you are getting? हाँ, आपने एंटरप्राइज वैल्यू लिया था 3,94,000 डिवाइड बाय द नेट प्रॉफिट EBIT. Sorry, this is EBITDA. So you add depreciation also. So it's not EV upon EBIT. He is taking EV upon EBITDA. Which one? The depreciation. Okay. EBITDA. I'll show you this number. So we have, take this number, depreciation is 4,000 and interest is 1,600 and profit is 8,000. 8,000 plus 4,000 plus 1,600. Okay. So 8 plus 4, 12, 13, 14,000 something. Okay. So you take the Ultratech and take 3,84,000 divided by 14,000 or something. So how much you get? Roughly around. So there is some miscap. Okay. Again, because we have taken entire net profit. So we have to look at the adjustments there. Okay. At the bottom. So I'm just giving you a ballpark number so we can exactly match. Okay. So when I share the template where I've done all the calculations to the finest and then it matches almost the same. Okay. Fine. So EV upon EBITDA is how much? 26.9. Now, why we have calculated this metric? Very important. It is like, when we take EV, it is the entire assets of the company, and this profit belongs to the entire the profit being generated by all the assets. So EBITDA is, of course, it is only excluding the depreciation also amortization also. So it's a cash profit of the company. Okay, how much cash the company is earning. EBIT is operating profit, and EBITDA is operational cash profit of the company. Okay, generated by using all the resources of the company. Okay, not only the equity shareholders, but also the money given by the loans and bonds, whatever we have taken from the bank by way of loans or borrowings. So it includes that also. So EBITDA is what? Operating profits. EBIT is operating profit. So either we calculate EV upon EBITDA or EV upon EBIT. So the numerator and denominator are perfectly aligned. Because when we take a P ratio, we have the market cap, which belongs to the shareholders, and the net profit, which belongs to the shareholders. When we take the EV upon EBITDA or EV upon EBIT, the EV belongs to all the stakeholders, not only the shareholders, but all the stakeholders. And EBIT or EBITDA is coming out of all the resources being used of all the stakeholders, isn't it? So any kind of a multiple should be, I say it should be proper. The numerator and denominator should be proper. If the numerator is representing the shareholders, the denominator should also represent the shareholders. If the numerator is representing the entire stakeholder, the denominator should also represent all the stakeholders. Okay. So we have got 26 point something. Okay. Now we can compare it with other companies in Ultratech, cement company, and see whether how the this company is being trading. Like for example, let's go to the any other company, like let's go to Shri Cement or other company, and let's see how it has been traded. What is the EV to EBITDA? So because from the Shri Cement was 71, so let's see what is the 21. Okay, so it is cheaper, isn't it? Though P ratio is very high, but EV to EBITDA is just 21.2. Okay, fine. So that's a metric which tells you much better story than the P ratio. Okay, fine. So the P ratio has a leverage impact. If, for example, company is using more debt and debt is cheaper, so it will push up the profits in good times and decrease the P ratio, and the company may look cheaper. Okay, but that is not going to happen in the EV to EBITDA because the leverage has been taken out from the ratio. जो company ने उधार लिया हुआ है, borrowing करी है, that has been excluded from our calculations. Because if you borrow more money, because the debt is cheaper, okay, it will magnify the profits of the shareholders, okay, in good times. In bad times, it's going to magnify the losses. So it is going to have a leverage impact, which is going to distort the P ratio. Okay, and then the second is that the net profit is subject to more manipulation, because the accountants can always manipulate the profit, because following accounting policies to their convenience. Now of course we have the international accounting standards which everybody needs to follow. So there is a very less, leeway with the accountants, but the accountant used to manipulate. But EBITDA cannot be manipulated so much because it is above the bottom line. So it is not the bottom line, it's somewhere above some notches. Okay, fine. So some people say that we can calculate EV upon sales. Here we are taking the revenue. Revenue is subject to the least manipulation. So there was, let's see, there is another call. So price to sales. A price to sales ratio was found that the companies which are not making profits, which are not EBITDA positive or EBIT positive, or startup companies, or the companies who have not, but they are making sales, but they are not able to generate any profits because it's just start early days for them. So calculate a price to sales ratio. It will eliminate any kind of a bias because the EBITDA and net profit can always be manipulated. So the sales is the subject to least manipulation. Okay, fine. But look at this matrix. It is price to sales. It is actually the market cap divided by sales. This matrix is not, proper, because the numerator represents the market cap and the denominator represents the entire stakeholders' revenue. Okay, the sales have been done by the company using all the resources. So the better matrix would be EV upon sales. If you calculate EV upon sales, instead of here, if I say EV upon sales, so this is yet another way of looking this ratio. So this ratio would be much better, okay. But this ratio has come into use and become very popular, but it has some defect, okay, because price is the price that belongs to the shareholders, market price, and the sales is using all the resources, all the capital, whether being generated by the shareholders or given by the bank as a loan, everything has been used for generating sales of the company. But we are taking market cap versus the sales, which is not a right denominator. Except those companies which don't have any debt, okay, which have only equity. So then the ratios will be same. EV upon sales and sale price upon sales will be same because the company is zero debt. Is that okay? So EV will be nothing but the market cap only. Is it? So there are many ratios, like we have price to sales ratio, then we have price to book ratio also, where we take the price, the market price, and divide by the net assets of the company. Okay, fine. Now this ratio is not being used very commonly for doing the valuation. Fine, but this ratio also becomes significant in some industries like banking companies. Okay, I'll tell you why later on, or maybe today itself. So price to book ratio is 4.9. Okay, where how it is calculated? I'll just show you. So this is which company? Sri Cement. So price to book ratio. Price to book ratio. This is 4.9. So current price is how much? 29,000. Go to the balance sheet and look at the balance sheet. So it is equity capital plus reserves. Just add 22,000. Okay. Fine. Price to okay. So if we divide the price, that is a market cap, with this 22,000, what ratio you get? First of all, let's see. So price is how much? 1,05,000 divided by the 22,000. 22,000. This is this. How much you get? 4.9 or 5? Are you getting? Shrishti? So book value is basically all the assets minus liabilities, which is nothing but the shareholders' capital. If the shareholder capital is not given, you take all the assets minus all the liabilities excluding the shareholders' capital, you will get a figure which you divide by the market cap, you will get price to book ratio. Or you take the shares capital plus reserves and take the price divided by this, you will get a price to book ratio. Isn't it? It is basically 1,05,000 market cap, because we are taking the entire number. So we have to take the market cap, okay, and then we go to the assets. So we have 21,000 and 22,000. So 22,500. So if you take this and go to the number here, 1,05,000 divided by 21,000. Okay, 21,500. So you'll get close to about 5, isn't it? Are you getting it? 4.7. So somewhere the near number which has been mentioned here. Okay. So price to book is basically nothing but again, if you look at the numerator and denominator, they are okay, because we are taking the denominator, we are taking all the share capital and reserves, and on the numerator we are taking the market cap. So the ratio is fine. There is nothing wrong with the ratio, isn't it? Now price to book ratio. Okay. Now it is 4.9. Now, how it is used, where it is used, okay? Let's say, let's go to Nifty, okay? The top 50 companies of India, okay? And then if you look at, price to book value, what is the price to book value? 2.7. Now, this ratio is actually being used more for assessing the entire market, okay? Now, normally, India trades at a price to book value of 3.5 on an average. So going by this matrix, India is slightly cheaper compared to past. If I say that the price to book value of all the Indian companies on an average is 3.5 and currently it's trading at 3.27, then India has become cheaper. Suppose it was coming 4, then we say India has become very costlier. Okay, isn't it? It is just to assess the whole market as a whole. Whether the markets are overpriced as a whole or underpriced as a whole, we look at price to book ratio. So that is one application we find of price to book ratio, not for dealing with companies. except the banking companies, where the price to book ratio become relevant, because the book value in banking companies represent the market value, because the banks have to report everything basis on mark to market basis. Everything, all the loans, all the assets have to be brought near to what their market prices are. Banks can't report something historically. Like suppose company has to take a loan, company has given a loan to someone, 1,000 crores, and they expect only 900 crores to be fetched from him, because 10 crore, 100 crores become bad debt. So they will make provision and present only 900 crores. Though the company has given 100 crores, 1,000 crores loan, but it has become now, they can only collect 900 crores. So they will represent that, they will show their asset of 900 crores in the balance sheet rather than 1,000, and because they are going to make a provision in the balance sheet for the losses which the company may suffer and may not be able to return back the money. I'm just giving you a wild example. Okay. So the banks need to report everything on the basis of what is the current market value. Suppose bank has invested a lot of money into some shares or some bonds which are tradable. Okay. So they have to show them at the current market value and not at the price of what they bought it. Okay. Fine. So since all their assets are at current market value, so price to book ratio is okay. Whereas the book value will represent only the book value of all other companies, which is meaningless for any kind of a comparison. So for other companies, it is irrelevant. For banks, because it is showing you the current position, that's why it becomes relevant. Because all other companies are not governed by the RBI rules and regulations for how they are going to show their balance sheet and everything, all the assets. Okay. Is that okay? So price to book ratio. Fine. Any questions? So now what we have done is we have done a lot of ratios. Okay. Fine. Now it's a time that I can share you with a template which you start looking at, and now somebody wants to know from where we have got this number. Okay. Just before we end. So this is the number. Okay. Fine. So here we have gone to this site. Okay. Fine. Have you gone to this place? Go to forecast. Go to forecast, and what I'll do is I will give this link on the WhatsApp, this thing. So that you can just go and straight away and